How to avoid taxation on life insurance proceeds? Would not it be nice if you could pass on your entire estate free of taxation? While this scenario is highly unlikely, there are some smart decisions that you can make to avoid future tax consequences. One poor decision that investors seem to frequently make is the naming of payable to my estate as the beneficiary of a fractional agreement, such as an individual retirement account, IRS account, an annuity, or a life insurance policy. When you name the estate as your beneficiary, you take away the contractual advantage of naming a real person and subject the financial product to the probate process. Leaving items to your estate also increases the estate value, and it could subject your heirs to exceptionally high estate taxes. Here, we show you some ways to reduce the taxes on your estate and ensure that your heirs will benefit from it as much as possible. How life insurance death benefits may be taxed. One of the benefits of owning life insurance is the ability to generate a large sum of money payable to your heirs upon your death. An even greater advantage is the federal income tax-free benefit that life insurance proceeds receive when they are paid to your beneficiary. However, while the proceeds are income tax-free, they may still be included as part of your taxable estate for estate tax purposes. Section 2042 of the Internal Revenue Code states that the value of life insurance proceeds insuring your life are included in your gross estate if the proceeds are payable to your estate, either directly or indirectly, or to named beneficiaries if you possess any incident of ownership in the policy at the time of your death. The Tax Cuts and Jobs Act (TCJA) of 2017 determined the exemption amount at above $11.7 million for 2021. While maintaining the top rate of 40%, note that not all estates are subject to taxes, however. Using an ownership transfer to avoid taxation. For those estates that will owe taxes, whether life insurance proceeds are included as part of the taxable estate depends on the ownership of the policy at the time of the insured death. If you want your life insurance proceeds to avoid federal taxation, you will need to transfer ownership of your policy to another person or entity. Here are a few guidelines to remember when considering an ownership transfer. Choose a competent adult or entity to be the new owner. Then call your insurance company for the proper assignment or transfer of ownership forms. New owners must pay the premiums on the policy. However, you can give up to $15 per person in 2021, so the recipient could use some of this gift to pay premiums. You will give up all rights to make changes to this policy in the future. However, if a child, family member, or friend is named the new owner, changes can be made by the new owner at your request. Because ownership transfer is an irrevocable event, beware of diverse situations when planning to name of the new owner. Obtain written confirmation from your life insurance company as proof of the ownership chain. Using life insurance trust to avoid taxation. A second way to remove life insurance proceeds from your taxable estate is to create an irrevocable life insurance trust, ILIT. To complete an ownership transfer, you cannot be the trustee of the trust and you may not retain any rights to revoke the trust. In this case, the policy is held in trust and you will no longer be considered the owner. Therefore, the proceeds are not included as part of your estate. Why choose trust ownership rather than transferring ownership to another person? One reason might be that you still wish to maintain some legal control over the policy. Or perhaps you are afraid that an individual owner may fail to pay premiums, whereas in the trust you can ensure that all premiums are paid promptly. If the beneficiaries of the proceeds are minor children from a previous marriage, an ILIT will allow you to name a trusted family member as trustee to handle the money for the children under the terms of the trust document. Thank you.